Not quite double digits. But just running through these numbers, EPS of 41 cents did come in higher than what analysts were expecting. They were expecting around 37 cents per share. Revenue rose 16%, expecting 42 cents per share. Now, in terms of the analyst reaction, largely negative. We actually have seen quite a few downgrades on the street following the report. Oppenheimer downgraded to perform from outperform without a price target following what it called a weak Q3 report. The analyst sees a complicated path forward for Fortinet, saying Fortinet must now face the reality of constrained demand in its core firewall market, which will pressure its growth moving forward. Says the company is facing highly competitive markets that it was late to invest in. We also saw a downgrade out of JP Morgan to neutral from overweight with a price target of $52 from $67. So Fortinet currently trading at $46 a share. So still about $6 upside from here. But saying visibility into the potential rate recovery in fiscal 2024 is limited in light of macro headwinds and a change in go-to-market strategy that shifts the focus of the sales force. It sees risk to multiples, as investors continue to digest the impact of this cycle. And then Cantor Fitzgerald also downgraded shares of Fortinet to neutral from overweight with a price target of $50, down from $75, citing near to medium-term uncertainty for the downgrade. Believes the company's product appliance headwind situation will take longer than expected to normalize. I will say Guggenheim did lower, already off their lows of the session, but still down about 18.5% right now in the early going.
Oof, rough. Bringing everything else down with it, as we just saw with CrowdStrike, Zscaler 2. You know, a sector that so many thought could kind of do no wrong in cybersecurity, all the demand and that's needed to keep businesses safe, but I guess the market just got overextended.
Yeah, this was a good report, along with good guidance as well. If we look at earnings per share, a loss of 61 cents, beat the 69-cent loss expected. That's up 39% year over year. Revenue beat as well, 789.9 million. Above the 702 million that was expected, up 57% year over year. If we look at monthly unique players, that increased almost 40% at 2.3 million. Average revenue per monthly unique player was $114 in Q3. That was up 14% year over year. On the outlook side, they say for the full fiscal year, they now expect revenue between 3.67 and 3.72 billion. That's up from their prior guidance of 3.46 to 3.54 and above analyst expectations. They said the new guidance, in terms of adjusted EBITDA, has also been raised to a loss of 95 to 115 million. Previously, they were expecting a loss of 190 to 220 million. So some big moves on the outlook side, and that's got investors excited today.
Okay. So the profitability margin stuff at this point is this is one of the exceptions to the rule we were just talking about for this earnings season, right? It's literally just the words came out of my mouth that the way you win this earnings season is to focus on bottom line and to shore up balance sheets. That is not the case for DraftKings. This seems to still be a big enough first mover and a leader in its sector that the market is just like, fine, throw as much money at it as you can, just grow, get into more areas, dominate more of the online gaming space. I don't know. That's about it. There's not a lot of stocks out there like that still.
Yeah, I mean, that's the name of the game right now with these gaming stocks. Expand your state coverage when you can. They just launched in Kentucky in Q3. That's the 22nd state that they've got. Certainly try to take more market share. If we look kind of back in late July, we saw that pullback after ESPN and Penn Gaming talked about their ESPN bet deal. So that certainly puts some pressure on DraftKings, but also, just the outlook. I mean, we're going to have an investor day coming up on November 14th. I think we're going to hear a lot more about their multi-year outlook. But even for 2024, they said, they see adjusted EBITDA growth and revenue growth strong. They think the trends are going to continue. They expect revenue guidance of $4.5 billion to $4.8 billion for 2024. That's up 25% year over year from their midpoint range. They also expect 2024 adjusted EBITDA at 350 to 450 million. So some pretty positive numbers, not just for the rest of the year, but looking into next year as well. And to your point, this is one of those rare occasions where, really what investors are looking for is them taking more market share, and in this case, looking for more state coverage.
Okay. DraftKings, out in a world of its own right now, losing money. burning up fuel, but skyrocketing in its leadership and dominance in the sector. So now a 7.5% move. You got Caesars rallying with it. You got MGM. You got Penn. All stocks that have been beaten down real hard, so maybe due for a bounce. There's also some encouraging reaction, though, in the travel category as well. We had Booking and Expedia report. The stocks could not be more different in their performance over the past quarter. The idea simply was that Booking's much bigger international segment was still seeing a little bit of that post-COVID recovery in a way that the U.S. market had slowed down a little bit. But then it seems that bearish narrative on Expedia, the real U.S.-based booking business, was just too negative because this thing just woke back up and sprang to life.
Yeah, and I think that's a little bit what we're seeing here in the reaction, right? Because there's two very different reactions today. We have bookings down over 2%. We have Expedia up over 14%. Part of that is, if you look at Expedia, it's up about 9% over the last 12 months. You look at bookings, it's up about 56%. And there's some other narratives in here as well. I mean, if you look at Expedia, they're completing their VRBO migration. They've got their One Key program set up, which is really kind of bring a lot of their offerings together, which is something Bookings has done pretty well for a while. On top of that, I think the big move here for Expedia is certainly the share buyback. They authorized about $5 billion stock buyback. I think that's a pretty, it's a pretty big move for the company to say that they feel positive about going forward and what they're seeing in the travel industry. If we look at the numbers quickly, Expedia beat on earnings $5.41, up 33% year over year. Revenue beat as well. $3.93 billion, up 9% year over year. That was a record quarter. Adjusted EBITDA rose 13%. Gross bookings were up 7% at $25.7 billion. Booked room nights up 9%. Their business-to-business revenue also is doing incredibly well, up 26%. On the outlook side, they reiterated their expectations, expecting double-digit revenue growth for the year with margins above the year earlier.
Okay. Seems like a much better message than what the market had been expecting. Also, the fact that they're holding on to the guidance seems like that the negative kind of implications of our travel cycle, maybe we're overstated, maybe we're not dipping as much as people thought. Never hurts to throw in a buyback, especially when your shares are underperforming your big competitor. Booking giving back a little bit. Anything big to say about Booking?
Again, I think if all was equal, if the shares have been reacting the same way over the past 6 to 12 months, or if that buyback wasn't involved, I think these reports are somewhat similar. Booking's been doing very well. If we look at they beat on earnings per share, that was up year over year. Revenue was up 21% at $7.34 billion. Gross bookings rose 24%. Room nights booked increased 15%. Now, there was more commentary that we saw, out of some of the concerns over travel demand going forward, especially as we look at the Israel war and we look at other things going on, Hawaii, the fires, and certainly the economic outlook. That's been one of the things we've heard from the cruise lines, we've heard from Airbnb, now we're hearing from Expedia and Bookings. They're certainly focused on the macroeconomic situation and what sort of headwinds might be there.
Okay. Great stuff, Jeff. Thanks for the analysis. We got to get going because we got to talk some Apple. It's time. Take a deep dive into the report from last night. When we come back, it still is down, and it is holding back the NASDAQ a little bit here, but not a huge decline. Apple shares lower just by 1%.
Good morning. It is November 3rd. We're streaming the stock market today. We're watching the SPY, watching all these stocks rip rally today. We're trading futures, maybe options, stocks, some dailies. I guess it is Friday. We do dailies on all the weeklies. Sub up, like up, comment down. Happy Money sticks around. You can follow us on Twitter at HappyMoneyYT, as well as our Discord server. Link for those are in the description. I'll put a Discord link in chat as well. Hope you guys had a good morning so far. Sorry I had some computer issues this morning. I don't know what was going on. That was just my browser, and then Weevil started. I just had to reboot. So, all kosher now though. Just on a moon mission. We did have Barr spoke at 8. U.S. non-farm payrolls 8:30. U.S. unemployment 8:30. U.S. hourly wages at 8:30. Hourly wages year over year 8:30. See, 9:45 we had U.S. services PMI. At 10 we have Barkin TV appearance and ISM services, and then 12:45 Kashkari speaking. 3:30 Bostic has a TV appearance, as well as Barr, Fed Chair Barr. So it looks like 10 o'clock is the next data. Shouldn't be too crazy on it. Market's ripping though. We're in a short squeeze for sure. Yeah, look at that spot actually. Look at it now that it's open. That's crazy. Just the gapping goes. I mean, yesterday's candle was just absolutely wild. And just gap and go this morning. Proper bear market rally. This is when the bears and the bulls want it to go up. Because the bears closed. We want it to go up, up, up so we can get a higher price. Short it back down. Bulls are trying to reverse it, so we'll see what they can do. See if we can get a Santy Christmas rally. I think we'll see if we get up over that 437. We start testing top of that channel. That could be pretty bullish, or like a gap fill even, or even a new test on this high. But one step at a time. No time for a pullback this week. Holy smokes. It's quite the gnarly rally. Just pumping everything too. I mean, everything's been just getting beat down. Small caps, mid caps, large caps. Just tons of shorts closing. Also had earnings too, and it's been like, I don't know if they've all necessarily been that good, but it hasn't really mattered. They've just pumped anyways. Open doors up 17. Redfin up 22, Funko up 20. Confluence getting a big bounce. IP's up 13.5. GME's up 4.5. It's above that little resistance there. You can see retest that 1540 coming up. He's up 3.7. This one needs to break that high there, 1117. I was just relentless this morning. Good morning, Guts. Good morning, Kitty. Good morning, Bubba. Thanks, Guts. Appreciate it, man. Feel good making money on calls? Can be done.
Baby.
Yeah, I mean,
look at this market. How do you not go full
I
bull?
much prefers going up than
I
down.
think Apple,
Maybe it's full of bull.
I think Apple should be thinking the overall market right now.
Squares up
I think it
15.
might be testing that 200-day moving average about 171.
Crazy bounces. That was on
right
earnings, I
now,
guess,
had
right?
This report come out and the market had been flat.
Yeah.
So you've got to take that into consideration. Implied volatility has been crushed.
5 minutes for some data. We'll see if that has any effect.
1%. So I looked at a bullish strategy.
Data
here
farms
where I'm gonna
are
give myself
loving
some
it.
Duration, right? I want some time for this stock to recover.
They've been getting
Maybe
beaten
they
down the
do
last couple weeks.
outperform in that fourth quarter. The company doesn't guide, right? But the CFO did state that they're coming in line
Pace
with
is up
year-over-year
9.
numbers. So
Runs up
more
9.
of that revenue deterioration or no growth. So I looked at buying a call vertical, and I went out to the January monthly
Generac's still
cycle.
going.
So
Wow.
about 77 days till
8.8%
expiration.
on
So I'm
Generac.
going to buy an at-the-money call, the 175s.
That's crazy.
And that's got that higher delta. It reacts more like the stock. It's about a 50
Huge
delta.
bounce from
And then
the
against
lows.
it because maybe you think, hey, it can go higher, but maybe it
Once
can't
it
go
slows
that
down,
much higher, right? It's not going to hit all-time highs,
back to
just below
puts.
$200 a share again over the next 2.5 months. So look
could
at selling
consolidate and
the
chop, though, for
190 strike
a
call
while.
against it to offset some of my costs.
We'll
on the
see. If the
bullish
bulls want to keep taking it up, I
175
mean, they
call. So
do
you've
need to pull
got
back.
$15 wide call vertical to the upside
Or
here.
this is
paying
definitely
just
not
under
sustainable.
$6 for that. That'll take your break even just under 181 over the next 77 days. So you only need a few percent from
Before
the
we
current share
break
price of 175
this resistance, I would
to
say.
get above that break even. And on
Need to pull
verticals
back.
like this, when you're buying an at-the-money call, selling it out of the money call, it's going to be cheaper because implied volatility levels are down, so option
Frothy.
premium costs you less. So, but you definitely need to move higher in this one over the next 2.5 months to be profitable.
Okay, so you don't need to get to this $200 price target. In fact, you want it to basically stop at 190. That's where you're selling the call. So
Yeah, that
Aloha,
his is
Maui.
probably a 12-month price target.
Right, yeah,
This
yeah.
is a
Maui is
short-term trade.
spam,
Okay, all
a
right.
staple in your
By the
diet
way,
still.
we're within 1%
Even when you're
now
not in
of,
Maui.
even on the day. So Apple getting pulled up by the rest of the market. To your point, you got another approach.
Yeah, maybe a little bit more neutral to bullish on this one, where you're still taking advantage of some option premium, even though it's come in a little bit, but giving yourself a cushion, right? So we looked at going out to the December monthly cycle, so just about a month and a half till expiration here, and just sell a slightly out of the money put. I chose the 170 strike put. You're collecting roughly about a 280 credit on that, so that's what you can make, $280. But if the stock continues to slide, goes below 170 at expiration, you get to buy the shares at a discount. Break
Look
even
out
on
for this
one,
wedge, see if this repeats again.
167.20 over the next 42 days on this one. So
One
you're
right
giving
here.
yourself basically about $8.
It's usually a
$8
bearish
cushion
wedge,
to the
I thought.
downside before you get hurt. So on this type of strategy, you want to collect option premium. You're fine.
we
If
get
it
another one of
stays
those.
Here, goes a little bit lower, remains above
The
170,
short,
or goes higher, right?
potentially
You just
on
get
this
to keep that
break.
credit you collected, or hey,
The
I'm
long,
willing to buy the
touch on the
shares at about a
bounce on
3-4%
here, maybe with
discount
another
to the
wedge
share
setup,
price,
or some
right
kind of
now.
inverse head and
Gives you that
shoulders or
little bit
something.
of a buffer.
Okay.
But
All right,
with how high we
thanks,
are,
Tom, for the trades. Like it, two different approaches. And,
whole move.
One
A lot of the
being
move might be
little bit,
done.
more cautious
Yeah.
than the former, with the nice call spread for some upside Apple, and we're still about 1%. Apple down $2. Okay.
unless we get a
Definitely
pullback
a
to
little
safety,
bit of
then
a
we might
hang
have a
up,
nice.
But the market's not worried about it right now.
Short
Got a
play.
big rally underway. Two more data points. We're not quite done for the week just yet in terms of economic information. We're going to do some more trading as well after a big bounce back in Starbucks.
Always. Charge points to drop price target. Wow, there's your data. Green shoot. That's a pretty lofty price target for charge point. That would be more than just a bear market rally. That'd be a short squeeze. Nice, Bubba. That was a pretty big reaction to that ISM. Need beyond over 9.5. Get it. They still have earnings too. Let's see. 11.8. That blew up 10.25. JetBlue says it asked U.S. for countermeasures over Dutch landing rights. $4.5 on Dish. That one over 7. They have earnings coming up. Maybe it'll rally. 9% on space. On Celsius and freezer. On run. AMC's getting close to testing that high. Dog's got some gaps to fill. Big Teladoc at $20. %30 on Trupp. Funko's kind of sold off. It's up 19 still. Might come down a bit. IEP's up 15.5. All on earnings. Laser. Laser's up 14. They have earnings next week. Next Wednesday. See if we get another one of these wedges. Squares up 13.5. Fair amount.
For the non-manufacturing as well as the manufacturing. But Oliver, again, you know, a market that's really trying to make sense of it all in many ways, but I think in many instances a very strong number for what we're seeing here in terms of today, and feeds into some of the strength.
All 50 across the board. That's the difference between our services side of the economy and the manufacturing. And the U.S. is primarily a services economy, so the market has known where the strength is, and it shows up. And so there's no real big surprises here, right? The services stuff above 50 means it's expanding. We saw the manufacturing slightly below 50, so there's a little bit of contraction in the manufacturing part for the last read. But then before that, manufacturing was strong. So generally, altogether, the economy just remains stable, surprisingly resilient, particularly on the services side.
Which brings me back
The
to the
banks
point
are
earlier
sounded
that we
resilient.
made, is that the Fed right now is really leaning on this lag effect from higher rates, right? And sort of putting in a fair amount into the recent run-up we've seen in treasuries, doing some of the work for them. What if this numbers, or this economy, and these numbers remain very strong, and we start to see rates come off ultimately? Does that mean that the Fed's kind of found themselves in a situation that Powell warned us about a while ago, where it's too early? You can make a mistake declaring victory too early, because then inflation becomes deeply entrenched and it becomes more difficult to work its way out of the economy.
That's where I was very surprised to hear the Fed chair give credence to the market's kind of commentary about the bond market doing the Fed's work for them. Because, I mean, as we can see in the aftermath, the literal opposite has happened now. Stocks are rallying. So theoretically, there's a wealth effect there that's a stimulus for the economy. I get that. Look, it's only a couple of days. I'm just talking theoretically here. This is not tightening. This is loosening. These are loosening financial conditions. The dollar's almost down 1% again today. So the dollar's just went from the high end of its range to the low end of its range. That's stimulative. The yields coming down is stimulative. And by the way,
for reaffirming.
folks are saying, oh, be
There's a
worried
break of
about
that channel.
crude. Crude's like
I'm not
stuck
gonna
at
get
80
puts yet.
bucks. So I'm not even really interested in talking about crude anymore, frankly,
probably
because all
shall.
this talk about how crude's going to it's stuck.
I'll be
We
more
have
patient than that.
stimulative events
10
in the
o'clock.
market the last 3 days now. The idea that the market's doing the Fed's work is preposterous.
Yeah, well, you know, I'm kind of reminded of how it
get
kind of
them on
feels
a
to me like the Fed's looking for
test.
someone to do the work
On a
for them in
breakout.
some ways, and they don't want to take the blame if they do too much work and break the economy. It was just regional banks a while ago, and the tightening in terms of financial conditions, that was going to do some of the work for them. Now it's higher yields in general. Again, what has me a little bit concerned here, Oliver, is that with rates, with inflation at the level it is, there's still more work to be done here, yet we're being patient. We're kind of pausing right now. Many people are scratching their heads saying, hey, basically get back to work. Let's get inflation down to these levels, and then we can start to cut aggressively rather than wait and let the market kind of do the work for us.
That's what we were talking about this morning, which is we got to hope inflation comes down.
Absolutely.
I mean, look, if it does, then holy cow, Powell looks like a total genius.
Absolutely.
And everything's perfect. But the numbers right now are still too high. I mean, they've got to start coming down.
Or we're in a situation I presented earlier where Fed kind of gets what he was worried about, where we call victory too early and we have a situation where inflation becomes more deeply entrenched for a longer period of time.
That's what Bianco was arguing, is that really no matter how you slice it, just the math of the strength of the economy, wage growth, all adds up to yields being above 5% at least.
Oliver, I've been on the road a couple times over the last few weeks, a few road trips. I've never seen as many trucks on those highways, just packed full. I mean, this is an economy that's chugging along.
Yeah, all right, and the data shows it. Services data continuing to hit above 50. Thanks for the numbers, Ben. Appreciate the update. All right, let's talk some more stocks and some of the big earnings winners. Yesterday's move in Starbucks was an epic comeback. Let's bring in Kevin Green for a little of the aftermath. This was kind of a fun winner this week, Kevin, because it's a straightforward business that I feel like just got a lot of negativity swirling around it. And then it's like we extracted that in a single earnings report. What's been the response to Starbucks' big rally?
Yeah, we have seen the shares up around 12% since the earnings announcement here. And Oliver, I think you are right. I mean, the market was really concerned about the strength of the consumer, especially on the international stage. And we actually did see some bright spots in China as their pricing power has been able to really drive revenue. And even though they are seeing an increase in store traffic in China, they are seeing the average ticket, the average ticket actually come down just a little bit. But once again, we are still working on that reopening story for China, and they continue to double down when it comes to their international strategy. In fact, they actually did announce that they plan to add 17,000 locations by 2030 and also reduce its cost by $3 billion. Now, this is a part of its reinvention strategy, which is actually was initiated by former CEO
Seems like pretty good volume this morning on SPY at least.
This actually aims at adding around 35,000 outlets outside of North America by 2030, which is a significant increase from the current level at 20,200 international cafes. That's a 73% increase. And we are seeing that basically 3 out of every 4 new stores that's going to be added into Starbucks portfolio would actually be international stores here. So this also aligns with their $3 billion cost savings plan, where $1 billion is actually going to be saved by increased store efficiency. So once again, we are seeing not only strength here in the United States, but they recognize the opportunities internationally, and they continue to double down on that expansion strategy right now.
That's key because it's kind of like, it sort of reminds me of Chipotle a little bit, as the scale game, is kind of the easiest option for them. It's just, they've got a good model. No real need to fix it. No real need to fix it if it ain't broke, right? And I think people were kind of worried that maybe it was broken for some reason, and I never really understood that. They're now a major player in lunch. It's not just the coffee at this point. That was a big part of their, only real strategy shift of the last, 5 years or so. It's just that
really honing in on the digital ads or digital services side, digital delivery, things of that nature. And I think Starbucks is also going to really focus on that moving forward with this reinvention strategy. So yeah, I think the opportunities are there for Starbucks. I think the biggest key here, Oliver, is when the international market does provide a little bit of lower margins than what we see here in the United States. I think if companies can be able to capitalize and be able to drive not only price growth, but also trying to reduce expenses on the international side, that also will then drive bottom line growth. And I think that's going to be the key for not only Starbucks, but a lot of these international players like McDonald's or Chipotle or what have you. So I think that's going to be the key here moving forward when it comes to this expansion strategy that we're talking about today.
All right. Yeah, it looks like the chart is kind of in the middle of a range now that we'll find out which side they trade on. It seems like we might be kind of ebbing towards the higher end of the range, but it still is not a clear trend for Starbucks. So you got to get some follow through to this earnings. This day 2 definitely helping, up another 2.5%. Thanks, Kevin Green. Appreciate the analysis. Good commentary too on the similarities and differences between another big chain like Chipotle. Let's bring in Dan Deming. Let's talk about the market this morning. Let's do a little trading in Starbucks. Dan, we got a lot going on here, and in the mix, a classic like Starbucks, kind of proving its worth as a consumer staple in an economy with a stable job situation. I mean, it seems like a pretty straightforward case here.
Yeah, Oliver, it does. I mean, it's running into some resistance here at these levels, but this is key now. If we see it break above 105, then, we could continue to see some further upside as we close out the year. And but nonetheless, when you look at the price action, when you look at some of the general trends and some of the things you and Kevin highlighted, that, yeah, it does appear that Starbucks is in a pretty good position, particularly if the consumer maintains a fairly strong position and the economy continues to chug along at the pace that it is, which is, we had some significant growth in the Q3, expectations for Q4 to slow down some, but nonetheless still shows some positive growth overall. And looking at just the consumer trends, I think that Starbucks is in a position. Now, I think one of the things that was causing some concerns, however, that you and Kevin maybe didn't touch on as much, but the labor issues that they were contending with over the last year or two, that was another factor, I think, keeping a little bit of a governor on the stock. But now it does look like cost efficiencies are in place. They're going to continue to expand overseas. And I think that you're going to see continued upside in Starbucks.
Okay. So is this a trade that maybe gets to a 52-week high? Is this a buy calls or a sell put situation?
Yeah, it's a little bit of both.
Okay.
The thing about Starbucks is right now, because a $100 stock with $5 wide strikes, when you move out into the cycle, that makes it a little more difficult to kind of position. Whether I'd like to have $2.50 wide strikes or even $1 wide for a $100 stock. And you can get those, on shorter dated options. But when you look out, I'm looking at December here, Oliver. And really what I'm looking at is buying a call spread and then selling a put to finance part of that call spread, because the point is that if we do see a downtick to Starbucks back to 95-ish, that's a point where I don't mind picking up the stock. But at the same time, if the stock continues to move higher, this trade example allows you to, continue to realize that upside trend and participate. So what I'm looking at is in December, selling the 95 put and then buying the 105, 110 call spread. Now you could do that for about 25 cents.
Getting a lot this morning, man.
101.75. Now it's trading 102.75. A little more expensive to put that on, but nonetheless, the point is that it gives you pretty inexpensive access to the stock to the upside. And again, you have the opportunity to get put in the stock if there's some disruptions over the next month or two. We trade back down to that 95 level. You have the opportunity to pick up the stock at a much cheaper level. But if we continue to realize some price action here, Oliver, and we do drift lower over the next couple of months, this is a way to kind of mitigate some of the potential loss factor if you just bought the stock outright and still be able to participate to the upside.
Okay. So you get some of the financing by selling the December put, the 95, and thus also you're skewing this to be a very bullish trade as well. So it's not a typical spread, obviously.
Yeah, right, exactly. I mean, it's a one way just to kind of lower the cost of the call spread with the idea that you're okay getting long at a much lower level. Basically, that's the caveat here. If you just wanted to participate to the upside, you'd have to put out a little more cash to do that, but then you don't have the unlimited risk to the downside. But at this point, I think if Starbucks does drift back down to 95, fills that gap that we basically realized after the earnings, that's a level that seems to have solid support. And again, the idea is here to participate to the upside. Now, you could just do a risk reversal as well as a trade example, and that would just basically be selling the put and buying the call without selling the call above that. So you have unlimited capture to the upside above 105, and then you still have the opportunity to get put in the stock. But I think selling that call spread, I think over the next 2 months, Starbucks getting to 110 over the next 2 months is a level where you'd probably be pretty satisfied with the gain if we are continuing to realize this upside momentum.
All right. Now, if it totally crashes, your risk, you're exposed, of course, because you're capping out. You're capped out on the upside eventually. I mean, it's a far ways away, but eventually. But the financing of the call spread via the put selling means that you better hope Starbucks doesn't get shredded.
Right, you're putting out a cash secured put. So yes, and it does have, in theory, unlimited risk to the downside, but you don't realize that long exposure, however, till we get just above 95, because it's a little bit of a cost. But let's call it 95, basically, which is, if you look at the trend, that's really where we kind of found some support here the last couple of months. And again, the point is that you're okay getting long down there as opposed to buying it at 102 where it's currently trading. So you don't necessarily realize that $7 drop if it was to fall off from here, because again, this trade example allows you to give yourself a little cushion for that possibility. But again, if we continue to see upside breaking through 105 here and further higher price action, you get to participate without, just capturing the premium you would get from selling the put. This way you get to participate to the upside as well.
Okay. All right. Nice trade. Interesting. Thanks, Dan, for walking us through the structure in the Starbucks long position. Dan Deming, managing partner at KKM Financial. Let's talk some commodities when we come back, and some ETFs as well that track some of the trades that were big stories during the inflationary boom. Now commodities.
What's up, GDM? I mean, I don't think GME's volatile. I think the whole market's just pumping right now. All caps are having a big bounce. Mid caps. But yeah, it is above that resistance. Curious if it holds any sort of price action up here. That would be a good signs for reversal. Backdated flip on the daily. Still have that RSI divergence, which is nice. Buy looks like it's supporting a Christmas rally. Why are you down on your calls? %9 on JetBlue. Iron. A quarter on laser. Would have been a nice short right there. Get drawn in. Bottoms first. We could just be building another bull flag. See if we break out of this here.
exposure to coffee, there's exposure to soybeans, there's exposure to sugar. Okay, so it's not just a wheat strategy, but wheat is one of the primary holdings. Right now with OAIB, that is a base metals strategy that covers lead, nickel, aluminum. But copper is an interesting story, and everybody loves to talk about Dr. Copper. And copper right now in OAIB.
Dr. Copper?
And that's interesting because copper has been
Apple's down just a bit though,
difficulties this year due to demand from China with a slow Chinese economy.
I see. So this is the metals
all of these
group. The other one is the ags group. And
sold off stock,
is it always
getting shorts
holding a
closing
position
on them
in each of the component commodities, or can there be like an agnostic moment where there's just there's no short, or is it always one way or the other?
Your caps are taking a breather.
No, these strategies can go to cash, and so I think that's really important. And so it could pick which market has the opportunity to be long or short, again based on the machine learning, and so it does not have to be in those markets if it doesn't see an opportunity to. So
sounding resilient.
Our job is to try to track the index net of expenses. So they're actually passive ETFs. It's the underlying index that is active in choosing these positions, which is pretty neat.
Got it. By the way,
that is neat.
Doing its job, OAIB, looking at just kind of comparing to some of the general commodity weakness, it's held in there basically flat since the launch. So commodities have gotten hammered. So it seems like you've been on the right side of some of these trades here. I guess you've been short in a good bit of these to be able to stay even in a period where a lot of these prices are down.
Yeah, great point. Thanks for pointing that out. It is true. I mean, we had a very sophisticated position, I would say, in OAIB, where the index was actually long U.S. copper and short LME copper. So that's an inter-exchange spread. That's sophisticated strategy that you typically see
down a little bit more
in
here.
a hedge fund, for example. Okay, so one of the unique features of these ETFs is they are sophisticated strategies available, through your brokerage account. We don't have the 2% and 20% expense ratios.
Yeah, what kind of costs on these, Jay?
So in ETF terms, they're 1.49%, which might seem high when you compare it to SPY or something of that nature. But again, the sophistication of the strategy, yeah, exactly. You got it, Oliver.
So the idea then is, do you pitch this as a replacement, as like an alternative in a asset allocation where one might have space for commodities in general?
Yeah, so we see that big problem with the commodity sector. If you look at BCOM, for example, between 1992 and 2022, BCOM averaged less than 1% rate of return over those 30 years. So an average rate of return of less than 1%, that's dead weight in your portfolio. Now, commodities tend to zig when other asset classes zag, so you have that beta exposure or that potential diversification. And that worked in 2022. BCOM was up 13%. Stocks and bonds were both down, right? So that was helpful. But again, this year you have commodities down. And so the problem we were trying to solve for is how to deliver better investor outcomes in commodities. And we think active approaches and strategies that can go long and short can potentially do that. And we hope to prove that.
All right. Jake, thanks for the conversation and the heads up on the ETFs. Really interesting stuff. Jake Hanley, Managing Director and Senior Portfolio Strategist at TCREAM Trading. All right, a couple funds with some pretty interesting commodity approaches there for the active manager or trader looking for some commodity exposure without being pure long. Chartmaster up next. We're going to
all right, spies respecting that channel we drew.
Uber, Disney, and Warner Bros.
Check out this in a little bit sooner. This would have been a nice put again. Well, plenty of time, plenty of opportunities today. I finishes this inverse cup, the low of the day test. Bit of a bounce for a handle. Market's been open for an hour. Thanks, guys, for support. Glad you could be here on this lovely Friday. Thank you, 9 of you, for your likes. Redfin up 20%. The stock's just getting worked, finally getting a little bounce. This bullish IEP news is that they didn't lower their dividend. $1 dividend, yeah. There's reassuring news on the dividend. Need like a morning coffee. This is gonna be crazy if and so.
Expecting third quarter to be largely in line, but seeing some optimism with what we could expect from their guidance. Now, KeyBank did praise their company's position as a category leader, they called it, and pointed to several revenue opportunities like existing verticals into areas as well as shared rides, grocery delivery. I will say I know freight is a much smaller portion of their overall business, but that has been one consistent weak spot that they've got to figure out. But Oppenheimer also now sees shares as an attractive entry point, given the fact we've pulled back about, 4% from 52-week highs. Not a major pullback, but just saying that things are right now more attractive, and with a potential inclusion in the S&P 500 is something that's being rumored right now. Should Uber achieve this trailing 12-month GAAP profitability? That's still a major if, of course. But we were talking about these names several years ago, and we were like, when will they start making money? When will they be consistent? I think Uber's consistency has been something that's been so remarkable this year. And no wonder, of all of the analysts covering this name, 96% rated at buy, pretty much as high as you see. That's higher than Amazon.
Amazing. Yeah, and it once was very different for this company when it was in the throes of financial instability. Now it seems it's emerged from that. Chart-wise, Kevin, does it look like a breakout could be possible here if they deliver on these earnings?
Yeah, we are actually seeing a textbook setup for a breakout to the upside here. And if we're looking at a 1-year daily chart on Uber, we can actually see a situation where we had this long uptrend when we started the year out and was actually in an expanding channel, which also coincides with volatility in the stock. And we can actually see that with the price action. But if you look at point A, we actually have a bull flag that has formed here. This is basically a downward channel that is usually an indication that the market's trying to find an equilibrium, maybe shaking out some of those that have been long in the stock that you can sell it, and then maybe try to find an area of support to get back in. And right now, we did actually test that low end of the channel line about 4 or 5 sessions ago. We have been breaking to the upside ever since. Now, today in this session, we could be testing that upper end of the channel line right around $48.50. So that's something that you want to be able to look at. We also have the RSI, which is that first indicator on the bottom there. We were in this bearish trend, if you will, or this bearish divergence type of trend. Today, we are actually breaking out of that. Once again, that's another bullish bullish indication. And then last but not least, we have the MACD at the bottom. We did have the 12 EMA cross over the 26 EMA. That's a bullish indicator, but not the most bullish indicator. The most bullish indicator would be the cross over that zero line. And today that also may occur as we see that blue line or that fast moving average really approaching that zero line as we speak.
Okay. The fact that this thing has been able to stabilize up at these levels and now actually like turn around with vigor here the last couple of days, going into its earnings, doing it basically on the DoorDash report, to Jenny's point. A lot of confidence in the stock seems like being expressed by the market here. So that's a big change of pace from where Uber used to be. All right, let's switch gears. We got a couple content plays and customer and consumer play with Disney here, rather, Jenny. But this has been a mess for the most part. Like Disney hasn't been able to really do anything positive, it seems like, in the market's eyes. What are we looking for then on this report?
I know, the disappointment of Bob Iger. It was like when he took over the company, it's just been nothing but a bloodbath ever since. But
they even got roasted by South Park.
I know. I even saw that on Twitter. I'm even up on that on Twitter. I do not pay attention to
Bob
South
Iger
Park,
stock is going down. No!
Yeah, that's pretty much exactly what I think shareholders are saying at this point. But what's amazing to me, actually, is if you look at these streaming companies, I know they're very difficult to compare, but just like the closest thing to pure plays into streaming, like Disney, Netflix, Paramount, Warner Brothers, the highest buy rating ratio among the analysts covering these names is actually Disney, 76% rated at buy. I mean, higher than Netflix. Netflix is 66% buy. So that floored me. So clearly the street does still see optimism despite the fact that, I mean, we've pulled back about 28% from highs here. But following Netflix's earnings, I mean, they gave really strong guidance, free cash flow that was better than expected. They announced these price hikes for various plans here and internationally.
Netflix, you're talking about.
Netflix, right. So we saw that nice lift. And I mean, Netflix has been undoubtedly one of the earnings winners. So now, can that be repeated by some of their streaming peers? We'll have to obviously see when Disney reports Wednesday after the closing bell. But earnings estimates are down roughly around 12% just since August. So we have seen some pessimism that's now being priced into expectations. The value does reflect a sizable, 100% recovery in earnings on a year-over-year basis. So that's something. But top line expectations haven't moved very much. We are expecting around $21.7 billion here in revenue. That would be down a fractional around 0.5% from the same period a year ago. But estimates for Disney Plus subscribers, because I think this is really all the market pays attention to at this point, is around 146 million. That would actually reflect an 11% decline in users on a year-over-year basis. That's a problem. I mean, if you have a streaming service direct to consumers is all they talk about in their earnings call, and yours continuing to decline while Netflix continues to grow, it means you're doing something wrong. You're not gaining traction enough, at least.
Yeah, definitely.
See, Bubba.
Okay, well said.
They could very well just be consolidation, chop.
Super interesting that all the analysts are uniquely bullish on this when the price action's been so bad, Kevin. I guess that's just kind of how the sell side works. They're always in the mindset of like buying dips and hunting for value.
Bulls,
but
they really
from
need
a technical perspective,
they need to pull back
this has
some.
been one of the worst charts
They
out
want to keep
there.
rallying.
It has been, and I don't want to call about
Otherwise,
it,
this is going to be
we actually do have some
short-lived.
potential technical setups that could indicate that maybe we are seeing a little bit of a floor when it comes to the stock here. Let's talk about point A. Now, obviously, we did see the stock move to the downside. It's been more of a stair-step type of move to the downside. But at point A, we are seeing this consolidation, and it's for the most part an evened out consolidation. So not a bull flag, not a bear flag, just showing that maybe we are seeing some exhaustion when you're looking at these sellers in the marketplace. That also coincides with low volume. We are testing the higher point of that channel right now. And also just keep in mind that resistance at the $88.53 level is going to be the point of control on the volume profile. That's going to be an area a lot of technicians are going to be focusing on. RSI is also making higher highs and higher lows as well. So that's also another bullish trend that we want to kind of keep in mind here. The momentum is pointing to the upside when you're looking at the price action. And then last but not least, we have point C, that MACD. Here's another reason why we actually see a long-term bullish trend, if you will, when you're looking at the MACD. Higher
Wish
highs,
I could have an alert for
highs and higher lows, if
crossing
you will.
this
We are actually
line.
close to crossing that zero line, which is a long-term bullish setup. So overall, I could see the technical reasons why you could say maybe Disney has some room to the upside here because of these, the exhaustion of the sellers, the technical indicators, not only on a short term but on a longer term basis, pointing that a breakout could potentially happen here. I think the fundamentals are going to have to complement that thesis, though.
Nice. All right. So the groundwork there technically is in for some possible improvement and reversal. Hey, with the stock market
Do it
rally the
over
way
a
it is
moving
after
average.
this week, anything seems possible. So Disney maybe will have the right timing finally if they can deliver on the report. Warner Bros. Let's go there. Kind of an interesting one in all of this, Jenny. I'm never quite sure how they fit in, frankly.
I know, because they have so many different, names under their portfolio. That's what's amazing to me. I mean, you've names like HBO, TNT, Cartoon Network, CNN. I mean, so they have that legacy TV while also trying to really push HBO Max, which I
think is the best.
I do too. I will say their content is king. They're consistent, and you know what? They're like quality so much over quantity, whereas like Netflix just puts out.
They never miss.
They really never miss. So for that reason, they're getting more expensive though. So that's something to consider. But I guess everyone is. They have not though had earnings. They've not reported a profit since their first quarter of 2022. But what's interesting is they have kept a positive cash flow. So when looking at the comparison of some of the profits and losses of Warner Brothers versus like its closest peers, naturally Disney, Netflix, for example, with the last 12 months of data, they are all generating very similar free cash flow. But Warner Brothers is worth about 1/6 of Netflix and Disney, or about 1/8 of Disney at this point. So keep in mind, Netflix does have 2.5 times the subscribers. I mean, Disney has around 1.5 times the subscribers, so that checks out. But still, the market has given Warner Brothers this relatively low valuation, primarily because it's much more leveraged than some of its peers. And I get that. The traditional TV market is one that there is the thought it's dwindling. I mean, I think we see that with cord cutting. This is not a new story. But I think there's also something to be said about it's at a more attractive entry point now into its earnings next week because of that low valuation. I mean, it's not sky high like the way Netflix has become. The argument could be made that we're not really seeing this name capture as much of its potential upside, again, given its various brands. But then I also say this does have that legacy TV exposure, which is something of a concern. So it's a mixed picture. I mean, this name was one of the best performers earlier this year, and we've just since given up, I mean, a good like 2/3 of that rally. We're still up 22% on the year, but a lot of today's strength is on the back of Paramount reporting better than expected figures for its third quarter. So we're up like 4% today. That's a Paramount move, I'd say.
Yeah, I do. I used to kind of put them in the same category, but then Paramount really started pushing the Paramount Plus, so it's kind of become...
And Paramount Plus is bad.
Yeah.
There's nothing on it.
It's a mess. Well, there's, what were we talking about yesterday that's on it? The John Wick spin-off, The Continental. But, Mel Gibson's in that, so don't mention it. People are going to freak out. Kevin Green. I'm an HBO Max guy through and through, and so the Warner Brothers chart kind of hurts me a little bit inside. Pulling back so quickly, as Jenny pointed out, but does it still have like a baseline trend long term or what?
I think there's going to be a little bit more of a breakdown to go here, Oliver, even though the price action over the last couple of sessions has been really great. And here's the reason why. We can kind of tell this story. If you look at point A, we hit those highs as Jenny was talking about, but then we did see this expanding downward channel here that also coincides with some volatility once again. And point A, we had this bear flag. Once again, consolidation pattern, kind of tried to move to the upside here. We did break out, and then once again, volume came in, and actually the stock faded down to the downside here. The velocity of the move to the downside is also concerning, along with the volume that coincided. We also have another bear flag that happened in October here. It was a small one, but one to still kind of call out where we did break down. And now we are seeing a situation where we are seeing price action move to the upside here, but you have to keep an eye on the levels, or the stair-step levels for resistance. That's going to be point B. So that's going to be $12. You're going to look at $13.25, $14.50, $15.50. It's no coincidence that you're seeing these dollar increments, or these $75 or 75-cent increments when you're looking at the stock. A lot of technical traders like to look at these whole numbers, if you will. And then C, and this is the most important part of this whole chart, we have not seen a blowout candle yet. So even though we are seeing this price action to the upside, it's been very aggressive. The volume has been, for the most part, about average of what we've seen over the last 6 to 8 months. So that does not actually indicate that sellers are done selling or buyers are really trying to step in. I have it highlighted here in December of last year, that little circle there. You look at that volume compared to what you see for the average. That is what a blowout candle looks like. You see a significant amount of selling taking place. You see a consolidation pattern, and then what coincides with that is an upward move in the price action along with volume. We have not seen that yet. I would be very cautious. I think this is a fake out for a move to the upside.
All right. Wow. Warner Bros. Coming back kind of from the dead here after a real ugly breakdown in the chart. So a few of these kind of have some themes. Disney maybe kind of basing, Warner Bros. Potentially here.
I like his
a
TA.
little bit of inflection. And then Uber, the standout winner chart-wise. It seems like could be a
see,
layup if they deliver good earnings. Thanks, Jenny, for the preview, and thanks, Kevin Green, for the technicals. When we come back, we'll check out another upside mover today in a sector that has had a rough go the past few weeks. It's EVs, in this case, NIO, up about 4% despite announcing layoffs. Maybe the market interprets that as a good thing for their profitability. Maybe the market is just happy to buy anything today. It kind of seems like it. Russell's up 2.5%. We still have gains. Do note, though, that we did get stopped out, and we haven't been rallying now for about 40 minutes or so.
Streamline its operations and reduce costs. They say that
all
the
from
firm
my people.
Thinks the share price is likely to react positively to the announcement. They've gotten that right so far. As the stock
barbecue might just cause an upset.
Does move higher by 3.6% here, Oliver. And they talk about that cost cutting appears imperative for the EV maker as it continues to burn cash and its losses mount in the first half of 2023. As I said, it's a firm that has an overweight rating with an 1870 price target, and they believe that this move, if it's effective, should gradually alleviate market concerns on the cash flow and financials. So, look, this remains to be seen. The competition has ramped up tremendously in that marketplace, and NIO, while they were like the first to market, at least in terms of the publicly traded markets, they've been caught by their competition that's a little bit newer.
Okay. Yeah, it seems like market, either overall just has risk on or to the point of the analyst as well. Maybe this can be construed as a good cost-saving measure. Though it is a little, I guess they're not quite as in like the ramp mode, right? Because they've got a better kind of grounding, established business. But at the same time, there's so much competition too that I would think that a smaller workforce might limit some of your productivity longer term. So I don't know. It seems like there's a real trade-off here.
Yeah, I mean, I think you could look at this, Oliver, as maybe a necessary step, given the fact the financials have been getting worse, not better, in the growth. But at the same time, you got to be growing if you're not profitable. So they're going to have to thread this needle pretty tightly.
Okay.
Today, that's a 6% move.
Yep.
Yeah, so, I mean, that's 6%. That's